All of the problems covered in my videos can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link, you can download a copy of the workbook for yourself. Also on the website, you'll find links to all of my accounting videos, not just the ones I've uploaded to YouTube. I've uploaded over 100 extra videos on this website that you can't find on YouTube. So I do hope you'll check out accountingworkbook.com. All right, let's begin our problem. In this video, we're going to tackle problem 2-2A from our accounting workbook. The question says, in August 2017, Maria Chen started her new taxidermy business, The Right Stuff, Inc. The business focused on preserving family pets after they passed away. The following transactions occurred during August, and there's a big long list of transactions. Our first step here is going to be record journal entries, and I'll do that in the first video. In the second video, we'll look at T accounts, and in the final video, we'll look at the trial balance. So the first transaction here, Maria invested $1,000 in cash in exchange for 250 common shares. Okay, we've got to remember, whenever the investors are making investments, we are not the investor, we are the company. So we've got to say to ourselves, is this company getting money or not? And the answer here is the company is getting cash, right? So the company's cash, the company's assets are going up, they're increasing. So we're going to need to debit cash. So I'll date this August 1st. We're going to debit cash, columns over here for debits and credits. We're going to debit cash for $1,000. In exchange for cash, we gave up common shares to Maria. Maria's shareholders' equity is increasing, right? Her piece of the company goes up. Of course, we've really got 2 equity accounts we need to be worried about early on in an accounting course, maybe 3, but the 2 real ones we need to worry about are common shares and retained earnings. Clearly, this is a common share transaction. The third one might be preferred shares. I wouldn't think you'd be touching AOCI very much, and there's not much else to worry about in terms of equity. So her shareholders' equity is going up, and the account we need to credit is, of course, common shares. Now, we don't credit it for 250, right? She got 250 common shares. Well, they must have cost $4 each. So it's $1,000 that changed hands. We're worried about money here, not numbers of shares. Or, if I bought 100 pairs of socks for $2 each, I wouldn't debit socks for 100 to say I had 100 pairs. I would debit socks for 200 for the amount that I paid for the socks. That might have been the worst analogy ever. Let's continue. Let's move on with our lives. August 1st, another August 1st entry. We rent workspace, paid $600 for the month of August. Okay, we're going to credit cash because we did pay $600. Now, our debit, we've got a choice to make here. And if you want to be technically correct, the best answer here is probably debit prepaid rent. However, in reality, most companies, when faced with this exact situation, will debit rent expense. We'll get into what prepaids are next module, module 3. For our purposes, though, I think maybe not the most technically correct answer, but certainly an acceptable answer here will be to debit rent expense. Rent is a cost of doing business, and this is their rent for August. So by the time they're doing any financial statements, they'll have to adjust this rent away anyway. So most companies will just debit rent expense at this moment. If they buy multiple months of rent at a time, I would absolutely consider debiting prepaid rent. But if they're just paying rent 1 month at a time, debiting rent expense is completely appropriate in my view. And again, we'll talk about why this is debatable maybe in future videos, but at this point, just know debit rent expense is probably your best route. I don't think you're wrong if you debit prepaid rent though. Okay, let me bring this down. I've been having a tough time bringing this down. August the 2nd. What's happening there? August 2nd. The company borrowed $5,000 in the form of a long-term bank loan. The money was planned to purchase much of the equipment that would be needed. Okay, whatever we're planning, who cares? As an accountant who has to record journal entries, we don't care about plans. plans are for management accountants and economists. We want to deal in reality. What happened, right? What happened? We borrowed money from the bank. Okay, so did money change hands? Yes, cash changed hands. Is our cash increasing or decreasing? Our cash is indeed increasing. Cash is an asset. It's increasing. Debit cash. I love taking shots at economists. Our credit here, because I love economists, frankly. I think economics is like such an awesome subject, but we'll leave it for another time. The company borrowed $5,000 in the form of a long-term bank loan. Okay, so we borrowed money. It was a bank loan. This represents a liability to our company, right? We owe somebody money. We owe the bank money. We're going to credit it to make it go up because we owe them more money than we owed them yesterday. So let's credit bank loan payable. I always throw the word payable on most liabilities, really to drive the point home that it is indeed a liability. Okay, next up. Purchased equipment, $4,000. Paid $1,000 with the rest payable at the end of August. Purchased equipment for $4,000. Okay, paid $1,000. So the first question I want to ask is, did cash change hands? The answer here is absolutely cash changed hands. If cash changes hands, we credit, or if decreases as it did here, we paid it, we credit cash. So I'm going to credit cash for $1,000. But we got equipment of 4. So equipment is an asset. It's increasing. Debit equipment for 4. This doesn't balance. I'm clearly missing a credit of $3,000. I've got to say, what is this credit? Well, it says I paid $1,000, but the rest is payable. Well, if the rest is payable, that is an account payable, right? If you go to a store and buy something and you don't pay right away, you say, send me the bill. That generally for a company will represent an account payable. This is certainly not an exception to that rule. This is an account payable on August 5th. So debit equipment, credit cash, credit AP. Received and completed the first taxidermy job, a poodle named Rex. Received $400 cash. All right, so did cash change hands? Yep. Are we getting cash or paying cash? We are getting cash. So let's debit cash $400. We're going to credit. It's us doing what we do to earn money. We do taxidermy work, so we're going to call this taxidermy revenue. I did this problem in a class. Most of my class didn't know what taxidermy was. The reason I wrote the question this way is because I think taxidermy is amusing and kind of morbid. Google it if you're not sure what it is. It's definitely interesting stuff. No pun intended. Okay, let us move our little chart down a little bit. Come on. This thing is driving me up the wall. Driving me bonkers. When I move stuff down, see, it didn't take the D with it. The D in debit there next to assets. Okay, anyway. The problems I've got are not your problems. August 12th, we purchased supplies on account. Did cash change hands? No. If I purchase something on account, that's generally an account payable. We'll deal with this in a second, though. We got supplies. So supplies are an asset increasing. So let's debit supplies for $200. We're going to credit. Well, we didn't pay cash. It's on account. Credit accounts payable for $200. Let's carry on. Completed the second taxidermy job. A chocolate Labrador Retriever named Kit Kat. $600 on account. Okay, when I pay for something on account, like we buy supplies on account, that's accounts payable. When I do work on account, that means somebody owes me the money. That's accounts receivable. So on August the 13th, I didn't get any cash, but what I did get was an account receivable. I have now somebody that owes me money. They didn't owe me money yesterday, but they owe me money today. Accounts receivable of $600. I am owed $600. Our credit here is to taxidermy revenue. We did the work. We earned the money, even though we weren't paid. August 14th, took a dividend of $500 to pay for personal expenses. Okay, we don't care what they took the dividend for. Once the money leaves, we don't care if they bought a new house or they paid for their, I don't know, mother's birthday gift. That's irrelevant to us. Took a dividend of $500 is all that matters here. Okay, so they took a dividend. We assume that they took a cash dividend. It's not said, but I think that's pretty strongly implied. So we credit cash because our company cash is going down. Their personal cash goes up, but our company cash goes down. 500. Our debit here is to dividends. Not dividends expense, that's for sure. Dividends. Your prof may have you debit retained earnings, and they're not wrong. They're right, but this is also right and also acceptable. Continuing, received and paid the utilities bill, $200. Okay, received and paid. So the question I ask is, did cash change hands? The answer I give is yes, cash changed hands. Credit cash for $200. The debit here, you get a utilities bill. So utilities are a cost of doing business, right? They're an expense of a company, and we always debit expenses. Debit utilities expense for $200. August 20th, we paid for the August 5th equipment purchase. So did cash change hands? Yep. Is our cash going up or down? It's definitely going down if we're paying for something. I don't know how much we're paying though. So let's go back up to August 5th. August 5th. Oh, this one. Oh, this is a little tricky. We bought equipment for $4,000. We paid cash of $1,000 up front, and we said we owe you $3,000. Well, if I owe $3,000 and now I'm paying what I owed, I mean, I'm not going to pay the full amount, that's for sure. I'm going to only pay what I owe. I got to credit cash for $3,000 to say, oh, I'm paying what I owe. Our debit here is to accounts payable to say, I got to reduce that liability. I don't owe any longer. I'm just going to bring this down. I don't know if this has been doing me any good to keep moving along. It's sure been a pain in my neck, though. It's a funny thing. I use a piece of software called OneNote, and it's really good to work in for most things, but some things it's a little bit weird and painful. Okay, August 21st, received a utilities bill, $200, did not pay yet. Okay, so actually this is a little bit weird. Received and paid the utilities bill. I'm going to change this in your question to telephone bill, and I'll change it in the original question, so you will be seeing telephone bill. Received a telephone bill, $200, did not pay yet. Okay, so we got a telephone bill on August 21st. Debit. Telephone expense. Getting a telephone bill, it means we have a cost, $200. Expenses always take debits. Credit. Did we pay? No. If we paid, we'd credit cash. If we don't pay a cost, we credit accounts payable, or at least that's what we default to. You know, sometimes if we don't pay costs, we might credit something else. Salaries payable, wages payable. It depends on what it is. But if it's just part of our day-to-day business, accounts payable seems to be the best. Receive payment for the August 13th job. So August 24th, we get paid. So I'm going to debit cash before I even know what it's for. And in fact, if I was owed money from a previous job, I know to credit accounts receivable before I even know the amount, right? I know they were paying for something that they owed me on. So let's go up to August 13th. This was this chocolate Labrador named Kit Kat. We debited AR 600, credited taxidermy revenue 600. Well, now we got paid the 600. So debit cash 600, credit accounts receivable 600. Completed a third taxidermy job, a calico cat named Spot. Received payment. Okay, so we did work and we got paid. August 27th, debit cash, because we got paid $250. Whenever I get paid, I debit cash, and we credit taxidermy revenue $250. Marvelous. Paid salaries on August 31st. Okay, paid anything. Paid X. I know I'm going to credit cash. Let's deal with that. Now let's figure out the debit. Salary. Salary is a cost of doing business. Salaries are an expense, and expenses always take a debit. So debit, salaries, expense, $2,000. All right, ladies and gentlemen, the good news is, wait, $1,000. After all that, I get to the very end and I completely screw up my last journal entry. Fantastic. I'm not redoing the video. We're to the end of the journal entries. In the next section of video, we are going to do T accounts, and we'll do another part to the video where we transfer the journal entries from our T accounts to a trial balance. And we'll learn how to do that in part C of this problem. Stay tuned.